At Golden Financial Services. Today I'm going to find some gem stocks, just some golden eggs here. I'm going to find some money-making stocks that you're going to absolutely love. Strong buys. These stocks can make you a lot of money. This is what we're going to do. I've done this many times over the years, and it's never failed me wrong. Now, do keep in mind, a stock screener, okay, all it's going to do is it's going to reveal a bucket's worth of stocks. And again, I call these just like gems, hidden gems. So it's going to reveal a bucket worth of stocks, but then you have to sort through each one and look deep into the financial records, the income statement, the balance sheet, the cash flow statement. But anyways, I'm going to get you a bucket of gems. We'll narrow it down to 10 or 20 maybe, roughly. And from there, yeah, there's going to be some money makers in there, strong buys. You know, these are the stocks that the analysts are, just finding out about, jumping on board. So here we go. I'm going to include mid cap, large cap, and mega cap. Small cap, I don't want to include small cap. They are just a little too risky for my taste. I'm going to get rid of this, the price. We don't care about the price. Okay, I'm going to include United States, and let's begin. So this is a stock screener. This is the Yahoo Finance stock screener, and we're going to use it to find undervalued, but yet stocks, companies, let's not call it stocks, let's just call it companies that are growing, have consistent revenue and earnings growth. And maybe they're not the Amazon or the Apple yet, but they're on their way. These are innovative companies. And okay, let's just jump into it. So first off, let's look at the current ratio. Okay, and the current ratio. So you have current assets and current liabilities. These are the current assets are going to get converted into cash within the next 12 months. So within the next year. The current liabilities, these are debts. They need to get paid in the next year. So you never want this to be below 1. You want to make sure the company has enough cash flow coming in, has enough money coming in from its assets to cover at least the current liabilities. So what we want to see here, we're going to put this between, Warren Buffett likes it to be above 1.5. But with the state of the economy after COVID-19, plagued most companies and caused a lot more debt. Things are a little different now. So let's just keep it at 1.2, and we don't want it to be too high because then the company may not be employing its cash in the right areas. Like, for example, if there's too much cash coming in and they're not investing it, not too much cash. I mean, if there's a boatload of cash coming in and it's not getting invested properly, that company, we want to avoid that because there could be issues coming due to that. So 1.2, and we'll keep it between that and 4.0. We'll go 4.5. Anything above 6, I really don't want to touch. Okay, so next we're going to look at the rate of return. We want to see a rate of return of at least 10%. So rate of return, and we're going to put greater than 10%. Okay, next let's look at the estimated revenue growth year over year. So that would be estimated revenue growth year over year. Okay, we want to look at the revenue and the earnings because sometimes the earnings may not be as consistent because a growing company is going to invest. It's going to take a portion of its revenue and invest, and that may affect its income, its net income, its EPS. So some years the net income may be lower, but it's only because more was getting invested from the revenue into growth. So you need to look at both. Estimated revenue growth. Okay, in this one, we want it to be at least 5%. Okay, so notice this on the right, the estimated results, we started out with thousands, and already It's at 227, above greater than 5%. Now it's at 148. Let's next add earnings consistency. So it's over the last several years, at least 5 to 10 years, I like to look at, when I'm really looking at the financials. But there needs to be consistency. If there is no consistency, you have no idea what that company's going to do in the future. So let's do at least, so we'll do low, medium, high. We want a consistent record. We want a consistent earnings history. Let's also look at the revenue consistency, because remember what I just told you, you don't want to just base it on earnings. You need to look at the revenue as well. So we're at 62 companies now. Low, medium, high. All right, so that didn't change. Okay. Next, we want to look at the valuation. With the valuation, we're only wanting to look at the undervalued companies. We want to buy cheap companies where we can have a margin of safety. So that is very important. Seth Klarman, they say he's going to be the next Warren Buffett. This is what he talks about all the time, having a margin of safety, buying for a lot less than what it's worth. Okay. Next, we're going to look at estimated earnings growth year over year. So we're at 35 now. We're going to put that at least 5. Okay, nothing changed. So let's go even higher, at least 8. All right, so now it's down at 34. I would actually like to make a quick adjustment, guys. Let's change this to 8. So we're at 34. Now we're at 28. All right, moving on. Debt to equity. The debt to equity, Warren Buffett likes the debt to equity ratio to be, well, what was the last thing Warren said? Warren said usually he likes it to be under 1.0, but with the state of the economy, companies have a lot more debt right now due to the COVID-19 crisis. So I'm gonna do less than debt to equity ratio, and this is talking in a percent, right? Let's do less than 1.2 or 120%. So check this out. Now it's down to 20 stocks. So 28 we were at, but if we do less than 120%, now it's at 20. So we just knocked off 8 companies that had way too much debt for us to even consider. Why take a risk investing in a company with a lot of debt when there are so many good buys in the companies that don't have a lot of debt? It's just common sense. Okay, I mean, my company, Golden Financial Services, we help people get out of debt. So having a lot of debt is something that we want to avoid in my eyes. We've got the current ratio. We've got the debt to equity. Let's see. Okay, next we're going to do, okay, here comes some important ones, guys. Okay, next we're going to look at the PEG ratio. So the price to earnings ratio, is important, but the price to earnings ratio doesn't take into consideration what the analysts are expecting the growth to be. So the PEG ratio looks at the price to earnings with the growth as well. And you want the best companies, that PEG ratio is going to be, the PEG ratio is going to be under 1. Right here. Okay. But you know what? Again, if we do under 1, you've got 4 companies left. That's it. But if we include 1 to 2 as well, which we will do, normally I wouldn't, But right now, companies, the average company is different than it was 6 months ago. So I'm going to include the 1 to 2 range as well. These companies may have been less than 1 6 months ago. A lot of these. So now we're down to 8 companies. These are going to be some hidden gems, and they're probably all going to be strong buys. So let's do one more ratio here. I'm not going to do the price to earnings, but what I'm going to do is something that's similar. Okay, the price is the market price and the earnings is the EPS. Okay, but something similar is total enterprise value to earnings before interest, taxes, depreciation, and amortization. This is just like the price to earnings ratio, but the difference is the total enterprise value to EBITDA. Okay, it's looking at the enterprise value. The difference between enterprise value and the price is that the enterprise value looks at the company's debt and takes it into consideration, and also looks at the company's cash and takes that into consideration. So this is like the true value of the company, not the market price, which actually, looks at all different things, including speculation and things that don't really matter. So here we're going to use this. So price to earnings ratio, Warren Buffett likes that to be below 20. Okay, a lot of companies are above that right now, but if you look at the total enterprise value to the EBITDA, it's under 20, and that's what we're going to look at. We want to look at the true value, total enterprise. Here it is. So total enterprise value, okay, by EBITDA. Here it is. This one, we want to keep this. It may not even make a difference, but we want to keep this under 18. Less than, okay, 18. That brings it from 8 to 7. So now we're really looking at these companies that are undervalued, and you're going to be able to make a lot of money on these. I would say maybe all of these companies are going to be a great investment, but again, you got to actually look at each company one by one. So here we go. These are the gold mines. So Alexion Pharmaceuticals, LKQ. I'm not familiar with all of these companies, but just to kind of give you an idea, let's just look at this one here. LKQ. You can see here this one 15% estimated return. Okay, you can see it's a strong buy, just about a strong buy, as I was telling you. Most of these companies would be a strong buy. You can see that what the analysts as of June, 7 are calling it a strong buy, 6 are calling it a buy. Okay. You can look at. So see what I was telling you before. Okay. The PEG ratio, it says currently it's 7.44, but as of March 31st, it was under 1, which is where we want it. See that? And also the other, so you can see here that the PE, the trailing PE ratio is 15, the forward PE is 19, but if you look at this other one that we looked at, the enterprise value over the EBITDA, it's 11%. So that's a good sign right there. And if you go to the right, okay, it was 36%. 36.54, 51. Look how high it was. Interesting. So right now, what this is saying is, this company probably took a huge dump due to COVID. Let's look in the last year. Yeah, exactly. So you can see this company took a dump off the cliff. It's only gone up about halfway since. So when prior to COVID-19, you can see that this company was selling for a much higher price to earnings ratio. Okay. Another thing I like to check is the holders. Okay. If the insiders for a company are not heavily investing in the company, why would you? So let's see what type of purchases. In the last 6 months, 22 insiders had purchased stock, where only 2 had sold. So you look down here, look, May 11th, you've got the director of the company buying shares on May 11th. You've got another director, all these different directors all buying company. It looks like they all bought the same amount of shares. That's a good indication. So all of these directors are purchasing stock on May 11th. All right, so basically the price, I'm sure this was some kind of company incentive though. And then if you look at the financials, you can see the revenue. The trailing 12 months. Okay, 2019, 2018, it's just consistent. It's consistently going up. The net income, consistently going up. Okay, it's all good stuff. Free cash flow, consistently going up. Okay, and one more thing I want to take a look at. The stockholders' equity. Beautiful, just continually going up. Okay, so let's jump back to the stock screener for a minute. Let's look at one more. Alexion. This is a pharmaceutical company. We actually purchased some of this. You can see the estimated return here is 72%. The performance outlook, it's all positive. You've got, in June, it went from 10 to now 12. So you have more analysts saying it's a buy. 6 say it's a strong buy. Let's look at the analysis here. Next 5 years, they anticipate 12.60, 12% growth. The past 5 years, 17% growth. So significant growth is what the analysts, there's actually over 20 analysts that are saying it's going to grow approximately 12% over the next 5 years. That's important. And then if you look at these statistics here, look at the PE ratio low. Enterprise value ratio here under 10. PEG ratio under 1. Okay. All this is what we want to have in a company. Current ratio 4.35. Debt to equity ratio under 1. This is all good stuff. Now, the holders, if we look at these insiders, 35 purchases in the last 6 months, but you can see here in May there were a bunch of insider transaction purchases. So this is all looking good. February there were more. Very good history here. So anyways, I'm going to leave this up with you guys. Let me give you another glimpse of these companies. Check them out on your own. See what you think. These are all undervalued, and these all have, well, most of them have a low PE ratio, and these are companies you definitely want to consider. Hope you enjoyed the video. Have a great day for now. Bye-bye.